Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over some information from Twitter. I'm going to interject my financial opinions in there as well. And it's mainly going to be about commodities, stock market related stuff, interest rates, all sorts of those things. And you know, I've been in the market since mid to late 2000s. That's kind of when I started paying attention to the markets. It was towards the end of the last commodity bull market. I saw a lot of the big moves towards the middle to end of that commodity bull market from like 2004 onward, and they were incredible moves. I saw some really big moves in natural gas companies, and that kind of what warmed me up to the commodity bull market. And I've never seen the beginning of a commodity bull market myself. So this is my first time going through the beginning stages of it, but I did I did back test and look at all the data from looking backwards and looked at the correlations and figured out at least what I think is good correlations and what causes people to rotate money around. In this, there are some things that are interest rate related. So when inflation comes, interest rates chase it higher. And then eventually, the thing that is driving the inflation, which is the demographic, runs out. That is my opinion, at least. I don't think the interest rate is what causes the problem. I think it's the demographic that runs out. There are crises along the way that happens, much like the crisis that we have going on right now. That crisis is tied to liquidity in the system, not solvency of credit and credit destruction from the real estate market, although there could be other areas that could get hit, like commercial real estate or other areas that are a little bit weaker than the residential real estate area. We do have increasing housing starts. They're up 10% for February, which is good news. So that's good. That is a very good thing. But obviously, we want to see a trend. We want to see that continue to trend higher or sideways at worst. And that is our credit inflation driver. And they don't want that thing to drive too fast. So they're going to continue. The market's going to continue to increase interest rates, irrespective of what the Fed wants or doesn't want to do. It's going to increase it. And I think they're going to let it go up because that's the only way that they can slow down inflation, is to basically destroy the demand from the credit side. And they have to if they want to reduce the inflation rate. So keep that all in mind. That's kind of what we'll be talking about on some of these is interest rates. And interest rates, just a reminder, that's what basically prices all assets. When we see an increasing interest rate environment, tech stocks go down, S&P 500 goes down, generally speaking. So it'd be sideways to lower. And commodities generally go sideways to higher during those time frames. It doesn't mean that you can't have big pullbacks in the middle of a commodity bull market. In fact, there's a lot of pullbacks in the commodity bull markets. And I know some people, they're going to say I'm right or wrong. I don't think that's the right mentality. You can back test this stuff yourself. You can look at it all you want yourself. And you're going to have to come to a strategy that works for you. My strategy is to play the whole bull market. I'm not going to try to trade every single minute move up and down. And I do daily technical analysis updates. People want that. And I am my channel to some degree is a function of what everyone wants. I am providing a service, and if people want to see something on a daily basis that's daily technical analysis, I'll do that. It doesn't mean that I trade on a daily basis. Doesn't mean that I'm going to get those right every single time. I take the big picture view. I stuffed a bunch of money in some of these in 2020, and I've added along the entire way. That's been my strategy. I'm choosing very large fractals, which means the companies are extremely volatile. And I'm going to ride this thing up. The more volatile they are, generally, the higher they will go to the upside when that time comes. Is the time coming now? We're going to find out in this clip. I'm going to give you my financial opinions around a lot of this information. A lot of this information is incredibly important. It's important to know, and I'll know which I'll note which pieces are incredibly important as we go through it. So let's go through it together. And if you want to join the community, you can join the community on finding-value.com for the Platinum membership. All right, let's dive in here. We've got, and if you want to follow me, it's at @finding_finance. So let's dive in. So here's some information. This is a lot of news and information. And this is basically telling you what the herd is starting to line up and do. It says, estimated silver sales at APMEX for the past week are now over 1 million ounces. In 15 months of nonstop tracking, I've never seen numbers like this. Additionally, what's also so spectacular is the fact that they've been able to refill so much inventory in that time. So there is a large run on physical metals. I talked about that last question and answer session. I said, if people can't get money out of the banks, what do you think the next best thing is to do? Well, just buy a bunch of silver and gold and platinum with it. I mean, that you can get that out of the bank really quick, and you don't have to go there and deal with cash. You can just transfer it over and go with an e-check, or do multiple orders with multiple e-checks if you have more money than that limit. Here's Martin. Martin, I've been reading a little bit of his stuff. He's not too bad. This guy's a pretty smart fella. I'll say that. Very observant. He says, I've been a lone wolf on this for so long. Tech is essentially a levered interest play. 100% correct, buddy. I totally agree. It's that simple. Few get to accept those in the tech sector who need free capital for their business plan to work. And it's not just the business plan. There's two aspects here, all right? And this is important to understand if you're an investor. There's two aspects. One is money flows from the investment side, and money flows from the sales side of these companies. If you've got a highly inflationary environment, it means that a lot of your basic goods and services, the needs of humans, go up. Food, shelter, energy. Their money is going to be, a higher percentage of their money is going to be directed towards that. And it's going to be directed away from the things that they might want but can't afford. Technology is one of those sectors that, maybe you're not going to buy an iPhone, a new one. Maybe you're going to decide to pay your electricity bill and heating costs, or gas in your car or truck, or the increased insurance costs, whatever it is. All right. But that is really important to understand. And what he has here is bonds. So this is the global equity bond market relative to technology. And this is US government bond yields. And you can see this basically track very well together. They're very highly correlated. If I were to look at the R squared value, it's probably over 0.8 just by looking at the two. So that means it's very highly correlated. So that is true. Tech is just one big leverage play to interest rates. That's really what it is. And you could say the same thing for oil. Oil is the same thing in an inverse relationship with tech. I'll just say that. Oil and platinum are my two favorite. It says, most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. And what he's talking about is when things are out of favor, that's where the value is. You have to buy it when everyone's calling you stupid and crazy. And I've noticed my view counts are down, and a lot of people are coming out calling me that I'm wrong about oil and all this stuff. So we're probably getting pretty close. There could be a little more downside. Getting the absolute bottom, very tough to do. What I do is get below a certain area, and then I just cost average in. And I do it in what I think are the best companies to provide the best risk reward to the upside with the highest probabilities. I'm a big oil and natural gas guy. I'll just say that. I think the setups are good, and I think the companies are strong, and I think they're cheap. I'll just leave it at that. Some of the other areas, the risk goes way up. And I don't think they track the markets as well, it seems like. And it's very hard to do that from an individual standpoint. It's hard to stand apart from the crowd. It's hard to not blend in. It's very hard to do that. And it takes time to learn that. It took me, I even fall back sometimes into that, I'll say that trap where I talk to other people and they almost convince me to buy something. It's like, whoa, time out. Like, this is not cheap. Let me go back to the stuff that I was buying originally. So you kind of have to, you have to know what you're doing, and you have to be able to think critically and basically stand away from the herd. It's very hard to do that. I'll just say that. We've got Lou Powell. He says, this is for Druckmiller. Says, what's obvious is obviously wrong. Hearing a lot of be defensive, economy is going to start to break down, recession time. He says probably wrong. And a lot of people are saying this right now. A whole bunch of people. And I don't know, it doesn't, none of the comments, none of the stuff here really bothers me that much. I'm going to do what I'm going to do, irrespective of what basically anyone tells me. If I get good signals in the charts, and I think that we're going to get a bottom at support or something like that, I'll throw some money in it. I'm not afraid because I'm taking the long-term approach. I'm going to buy, cost average in when I think there's good buying opportunities, and basically buy the dips on the bull market is what I'll say. Here's Josh Young. It says, U.S. gasoline demand is up 4.3% week over week. It says, so, I mean, that's a big jump in demand. And this demand, I think, will start to pick up here after spring break and going forward. So we could see, and I don't know when the absolute bottom is in oil and gas and all these other ones, but we could see bottom out here sometime very soon. And we just continue to go up because we've got some deficits out there in the back half of 2023, early 2024. That's where my eyes are focused. And all of this near-term fear is just providing a better buying opportunity, in my opinion, especially in a lot of the stuff that we watch. That includes oil, natural gas, uranium. Even if we break to the downside, guys, I think it will be short-lived, and it will be a kind of a flush out move and then a big move on to the upside. I call that the slingshot cheetah, false breakout, whatever you want to call it. But a lot of people get scared because of the price movements. You have to get past that price movement stuff. You have to focus on the bigger picture, the vision, what's happening ahead of us. And then you have to look at, well, what's happening right now, and why are people afraid, and why is this selling off? False breakouts can also happen by fear in the market. It just yanks it all the way back down. And then it slingshots way back up, just like 2020, where all the fear was in the market about COVID and shutdowns and all that stuff. That would have been an ideal time to load the boat. Now, could we be coming up to a similar point right here? Yes, we could be. And when that fear subsides, whenever that may be, we're probably going to go on up. So that's the way that I view things, and that's kind of how I focus in the paradigm that I look at things. How do you justify economic stimulus during a period of high inflation in a pre-election year through a manufactured banking crisis? If you understand this. Well, I think it's not just the manufactured banking crisis. I think there's a lot of crises that are manufactured. I'll just leave it at that. Now here's Ronnie. He says, recession. I want to go over this real quick, and I think this is important also to understand. So we've got this FRB Senior Loan Officer Survey, willingness to lend to consumers. Lending standards never get this tight without a recession. So we can see that these have come on down, and then we've had recessions. But this is going to continue to tighten, and it could tighten all the way down here and maybe even beat 1980. Why do I say that? Well, let's go over some basic math here. If the demographic coming into home buying years is basically coming into home buying years now, and their first-time home buyers are the age of 35, 36 years old, we have some years in order to catch up with all of the homes that need to be built based off the demographic. Projected shortfall, if this is right, is between 3 and 6 million. If we have an average housing starts is about 1.3 to 1.4 million. So let's call it 1.4 million. And let's say we can peak out. Last peaks were about 2 million homes being built in large expansionary phases. If that's the case, in order to catch back up, if we build 2 million homes in the housing starts per year, which is 600,000 homes above the average, and if we have a 6 million home deficit, it takes us 10 years to catch back up, if those numbers are correct. If it's a 3 million home deficit towards the bottom end. It would take 5 years to catch up if we were building at 2 million and a 600,000 surplus over the average demand. That's between 5 and 6 years. Add that to roughly where we are today, and now you're looking at 2027, 2028 to 2031 or something like that. All the way out to 2023 if it's the worst case. So that's a good 5 to 10 years from now. That is how you catch back up. That is what you should be focusing on. Everything else in the short term, it's noise, a bunch of noise. Now, also, when you go back and you look at the data, this thing came on up and dipped. We had 3 waves. There was also 3 waves in the demographic. I don't think too many people know that. So did the waves happen because of the increase in tightening and all that other stuff, or was it the waves coming of the buying pressure from the demographic? I don't know the exact answer there. My opinion is the waves coming from the demographic. They overbuilt, crashed, came back up, overbuilt, crashed 3 times. So the housing market went into a hyper supply phase 3 times right in a row based off the demographic. This demographic doesn't go in waves. It's just one big demographic that comes. So I don't think we're going to get the 3 waves as big. I think there's going to be waves based off of other things, problems in the system with increasing interest rates that scare and have fear in the markets, just like we have today. And those, I think, will be buying opportunities if you can keep your eyes on the big picture, long-term vision of what's going on here. And I'm just trying to describe all of this and link it with a lot of the information that we're seeing. So yeah, lending standards are tightening though. And they tighten when the housing market goes into a deficit and we go into an expansionary phase. So basically, call it competition for credit, and credit becomes a lot more tight. This is at an inflection point right here for the Standard & Poor's 500. It says gapped up above the yellow line this week. So it is still holding the yellow line breakout, but still has that possible blue head and shoulder breakout and back test. So squeeze pretty good now. Fed FOMC next week will decide the outcome here. So we're sitting on top of this yellow line. We're right on top of it. We had a very large day today. This was posted before it, and we went far higher today. I think that we are going to go higher because I think liquidity is going to come into the system. That is my take. Could I be wrong? Yes, I could be wrong in the short term. And I'm not playing the S&P 500 with really any money. I'm in commodities. But we could see a commodity rally with the S&P 500 stocks rally as well. We could see an everything type rally depending on what they do. If we don't get a large surge of, we'll call it QE or stimulus or whatever the heck they want to do, which they're already doing. So I'll take that back. They already are doing it. And I'll show you in a couple clips here. But I do think that's why we're getting a response in the S&P and some of these other normal stock market areas. Here's Cycle Bottom. He says, we are 25 to 35% away from despair in several high beta niches. Uranium. I don't think that's the case. I don't think we're over here. I think we are in this first sell-off to a bear trap. So we basically came off. We came out of a basing phase here. We came up and we're doing the first sell-off into a bear trap, and then we're going to squeeze the people who are bearish. That's where we're at. We have not bottomed on this bear trap yet, or maybe we have. I don't know the future. I don't know exactly when the exact bottom will be. What you need to know is where we are in this. Now, here's the thing. On a shorter term time frame, we could be going into this valley of despair on a different time frame. But on the big picture view, we're at the bear trap. The big picture view is what I think everyone is missing. That's why I'm talking about this so much, this bear trap. That is where we're at. We're at the first sell-off bear trap, and then we're gonna go into a launch phase. And we could get a false breakout. There could be all sorts of things that happen here. And this includes uranium, natural gas, and oil. All of those charts are at the first sell-off bear trap, and I think we're going to get a big old move. I've talked about this even a year ago or a year ago plus, because people thought we were in the year 2004. I'm like, no. We're in the first bear trap, guys. We haven't even sold off yet, and we're in it. Now, I'm going to try to buy wherever I can, and I'm going to buy it in a way that I'm cost averaging in where I don't know the exact bottom is. I just want cheap shares to get the big move that comes ahead of us. Right now, we're not close to anything up here, in my opinion. The public isn't in uranium. They don't even know what uranium stocks are. And that's my opinion. Lots of laughs. Balance sheet reduction hits an absolute wall as they walk back 3 months of QT in just 1 week. QE is back, baby. What this is basically they started to cut QT and then they reversed their stance and started ripping it on higher. We also have a pullback in QT, and look at the bank runs here, and they're ripping it on higher to the upside. So are they going to do QE, or is this considered QE? I don't know, guys. They're printing money. They're handing it out. They're doing loans. They're doing all sorts of crap. And they're adding liquidity to the system. That's what they're doing. And I did talk about this last week. I said, you know what they do when they hit a problem? They print money. That's how they solve it. They print money. And when money comes into the system, the problem is commodities can't take it. We can't grow GDP when the money comes in, so it becomes instantly inflationary. That's the problem. And then you've got more inflation and credit being expanded in the housing starts. So we could see a wall of inflation come at some point if this money gets into the hands of people and starts circulating. So yeah, that's what's happening. Remember, bank scares and some of this stuff, people might start spending more money. They say, screw it, I don't want to hold on to this. Let's spend it. Get it out of my hands. We'll see what happens, though. Here's Martin. He says, sorry, but you know something is broken when people sell energy stocks on worries over Credit Suisse. I've learned over the years that broken often equals an opportunity. The fear of the banking system and the sell-off is going to create opportunities in some of these commodity stocks that are incredibly well set up. And hopefully we can get into some of the deficits coming up here. It says, can oil WTI close the end of the week back above the 15-year pivot line? It's going to, in my opinion. It's starting to look like a possibility. That would be one heck of a week for a back test. And what this is we've got our first punch higher out of this trend line of a long, this is West Texas Intermediate crude oil. We have a long trend line going down. And if you remember this, it looks very similar, and I know it's on a different time frame, very similar to a long-term interest rate chart. Interest rates punched through, and then they're doing a back test. Oil punched through, and it's doing a back test, and I think we're going to work our way on higher at some point in the near term. But this is crude oil here. This is where I start to buy and load up. That's just what I do. Now, am I going to time everything perfectly and get the absolute bottom? No, I'm not going to. Just because either I don't possess the skill set, or I don't know the exact bottom like most everyone else. But I try my best to cost average in as close to that bottom as I freaking can. And I've been buying this whole kind of bottom area already. I've been cost averaging, loading up on shares of my favorite companies that are highly leveraged to what I think is going to be a very big move coming in front of us. A very big move. And whenever you break these long, big downtrend type patterns, generally they go very big to the upside with gigantic breakouts. So I think that's going to be the case for oil. Here's silver, and I know this is a very short-term chart. It's a 4-hour chart. It says setting up for possibly 4-hour inverse head and shoulders. The head and shoulders is going to be driven by interest rates, and I think interest rates are going to go up and could punch silver and gold lower just in the short term. But that does not mean that I'm bearish gold and silver on the long term. I'm absolutely 100% bullish on both of those metals along with platinum. But I just want to share the short-term stuff. It says U.S. production currently declines at 37% per year. That's not just shale, but all wells. And this is the Red Queen effect from of what's going on here. It says the U.S. oil production base declines at 37% per year. Calculation based on all wells in key regions that account for 88% of U.S. production. You can see the production going on up and up and up, and we've been declining the past few years here. We've held steady. We might come up a little bit in 2022, and then I think we're going to head on down lower. The majority of the new that's in these shaded areas that are colored, those are all the shale production growth. And this is the prior years, more of the, we'll call it the old conventional wells. These decline fast as heck. And if they start to decline, I don't know where the spare capacity is going to come. Now, it doesn't matter what I know. I understand that. But if we struggle to increase oil production, we're going to see a lot of inflation in the system. And Saudi's been coming out. They're very concerned about it. And that investments hasn't really gone into oil. And we're going to have to invest in oil massively just to stay flat. We could see some pretty big deficits out in the second half of 2023, 2024. I said, you need to get ultra bullish when everyone else is bearish and calling you crazy or stupid. Here's Berkshire. So Warren Buffett, he did a really good, he timed the last bull market in oil pretty well. What he's got here says Berkshire Hathaway buys 7.9 million Occidental shares. He is loading the truck up. You have to ask yourself, why is he loading the truck up? He says he's recently revalued purchases of 26 billion of Chevron and Oxy. Below an analysis of Warren Buffett's history and oil and gas investments and why recent purchases may indicate the best is yet to come for oil and gas equities. Let's just dive in real quick. I know this is getting a little bit long. He says, Buffett's recent purchase of major stakes in oil and gas companies are an indicator of his optimism for the sector. General sentiment and positioning in oil and gas has lagged, as indicated by energy's small portion of overall equity market versus historical levels. We are still very low levels of the energy composition. So looking at the S&P 500, they don't own oil stocks right now, but they are coming up a little bit. We're about to break this downtrend too, which is going to hyper move this thing. Two, it says, and while Buffett is known to prefer investments with stable, predictable, and growing cash flows and not cyclicals, he has intermittently owned and done well with oil and gas equities, particularly in inflationary periods much like present. So if we were to look at his previous buys, Buffett presents investment thesis for oil and gas management. He buys it in here before the big move. He sells a lot of his stuff there, buys PetroChina. Now, PetroChina, if you look, we've got the big move higher and then that first pullback, and he bought very much the bottom of that pullback in 2002. Sold it in 2007. Great move there. Obviously, a highly skilled individual trading these markets. He says, takes an initial position in Oxy, gets in even more. Berkshire takes an initial position in CVX, and he's still buying into this strength here. I think we've got a big move ahead of us that's coming, and I think Warren Buffett is definitely right on this. It says, aside from being brilliant value investor, Buffett is also an excellent market timer, given this impressive track record. It is worth examining some of Buffett's past oil and gas investments in detail. And I'm not going to go into the detail of these, but he's done very well investing in oil and natural gas, and he is actively buying right now in those companies, which I am also doing, just not those particular companies. It says, turns out QT was transitory. I just think that's funny as heck. It says, it could be wild. So this is oil. This is the oil market demand and supply. If it would like to load, let me try it again here. So this is the oil market demand supply balance outlook. This is what I look for. These are the market balances. It's not inventories. It's the projected surpluses and deficits over time. We have a slight surplus in 22 of third quarter, fourth quarter, a bigger surplus in quarter one, and then a smaller surplus in quarter two of 2023. The summer is going to eat through that surplus, and we're going to go into deficits later this year, the second half, quarter three and quarter four. This is going to eat through our inventories, and it's going to put pressure on oil prices to move on up. This is what the Fed is going to fight in the future. They're going to try to kill demand and kill credit coming into the system. That's going to make this worse. Credit coming into the system, which is inflationary, puts everything into a shortage. Oil is the feedstock to satisfy that shortage. So this is where I think we're going to see a problem, is the second half of 2023. And it's because of this market deficit balance that I am referring to when I say that a lot. He says the Fed put is back. This is the U.S. Federal Reserve total assets. You can see that they're buying up 297 billion last week. There are some charts showing that this could be a potential problem. Maybe we do have some further fallout ahead of it, but I'm just going to cost average in across that fallout in what I think is some of the best markets to be looking at. Here's real estate. It says housing starts rocketing higher last month, going to 1.45 million. Strong housing starts leads to more bank lending and general higher inflation. There's that little move up there. It's moving on up, and I want to see if it starts to trend higher again. We saw a pullback in the middle of 99, 2000, early 2000s, 99. We saw that pullback in here, and then we rocketed higher afterwards. This was a lending boom and a decline in interest rates to create that big boom here. This here is going to be genuine shortages. So, and deficits in terms of the real estate market in relationship to family gathering. So there's that. Oh, and I didn't hit this. It says how U.S. housing starts rise by about 10% in February, led by a surge in apartment construction. Just an FYI. But that is what I've got for right now. This is U.S. 10-year yields. Now, this could be the Batman pattern that we're looking at. We could see yields come back down. We could also see that the dollar is highly linked to those yields, where dollar weaker, yields weaker, and that is fuel for gold to go higher. I think in the short term, we could see yields move higher in the short term. If you kind of draw this down, back test, and we move on higher. I do think we could go higher in the short term before that heads lower, based off of market, say based off the housing market and also the charts. But overall, when that starts to kind of slow down and head back lower, gold's going to take off and silver's going to take off. And platinum should do very well in an inflationary environment as well. But that's what I've got for today, guys. I know it's kind of long. It's like 32 minutes or so. And that's all I've got for today. So if you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. Check out the website if you'd like. It's up to you. And join our community. We've got a 7 a.m. Mountain Standard Time Platinum question and answer session. And hopefully I'll see you there and you can ask your questions. And I'll go over more information about all this stuff. And I'll answer whatever questions you guys have. Catch you then. This is Finding Value.